Eric is the president and CEO of ICI, the Investment Company Institute, which is, for those who don't know it, the American and global trade association for mutual funds and unit trusts, so the main fund management industry. And I think a lot of the issues that we've been touching on just now are also being faced where the asset manager acts as the intermediary in the market with a retail investor. And it's really interesting to get that industry perspective. We had one on insurance in the morning, so it'd be very nice to hear your views, Eric, from the fund management perspective.
Thank you, Nick, for that. I feel after having followed Robert Afell and Jean-Paul Servet, my remarks will be a letdown. It's always hard to follow both of them. But anyway, it's a pleasure to be here, and thank you for inviting me. I did want to talk about Fintech as it applies to the asset management industry. And I start off with what I think has been the theme for the past 2 days of this conference is Fintech knows no boundaries. It supersedes geographic borders. But also, I think it's critical for us to remember that it is important to the prosperity of European citizens, just as it is to citizens in the Americas, in Asia, and in Africa. And what Robert Afell just said at the end, which is this balance between making sure that the benefits of Fintech are balanced against the risks is really the key question for policymakers. And I think behind that is the recognition that Fintech could very well be the most powerful financial tool of our time. Now, it's already transforming the way we invest, what we invest in, and it could ultimately overhaul the entire financial services ecosystem. And that means we need smart, sensible regulation. And what I would like to talk about is the importance of legal certainty, a level playing field, and regulation that respects operational complexity. And if we are able to address these issues, then we may harness really the opportunities of Fintech. So that's the focus of my speech. And I want to draw upon my experience here in my current role as an industry stakeholder, but also drawing upon my experience as a former regulator who had to address some of these questions that are currently being addressed today. So, I'm from the Investment Company Institute, and our mission is to strengthen the foundation of the asset management industry for the ultimate benefit of the long-term individual investor. Now, Fintech is a powerful means to that end. It can amplify the wide-scale positive impact that asset management already makes. And I think it's very clear here in Europe. Through investment vehicles like mutual funds, including UCITS, the asset management industry helps long-term investors save for big financial milestones. And by building equity, long-term investing in mutual funds can be the cornerstone of every individual's economic security. But individual investor capital is also a vital source of economic growth. Long-term investing in mutual funds provides the funding that builds new businesses. It turns small businesses into bigger companies, and it creates the opportunities on which current and future generations depend. It provides a link between investors seeking appropriate savings vehicles and the financing needs of the real economy. Now, on a macroeconomic level, the wealth created by long-term investing through funds can help relieve budgetary pressure on governments to provide for health, welfare, and security of their citizens. And this is particularly true in the case of aging populations, where the number of workers is declining relative to the number of retirees. And then additionally, as we transition to a net zero economy, mutual funds, as well as other regulated funds, will play a central role in financing a more sustainable economy. Now, most importantly for European policymakers, the growth of individual investing is a critical pillar to establish a genuine capital markets union. The more people who participate in the EU financial markets, the more vibrant, resilient, and stable EU capital markets will become. So put simply, long-term investors in mutual funds are a key to the success of the European Union project. Fintech can enable all of the above to be done more effectively and efficiently. It can help facilitate long-term investing. It can help build the individual investor capital that drives economic growth. It can help strengthen European citizens' economic security. It can help relieve the pressure on cash-strapped governments while making a bigger difference on environmental sustainability. And by making access to private investment easier, fintech can help consolidate the EU's markets into a true capital markets union. So fintech can deliver incredible value, but to do so, it must be appropriately regulated. And here I think back to my experience, both at the US Securities Exchange Commission and the Commodity Futures Trading Commission. When I was in government service, that's when fintech kind of went from a concept to a booming global industry. And I do recall the in-depth discussions that we had about fintech developments. For example, when I was at the CFTC, we were discussing whether or not to approve the first US regulated Bitcoin futures contract. And this balance that we talk about between supporting innovation and investor protection and financial stability were hotly debated. And I think we landed in good places in decisions that I've made so far. So when you combine kind of my industry perspective with also my respect for the challenge that regulators face, I wanted to offer some thoughts about how we can harness the benefits of fintech and offer some possible suggestions about what policymakers and regulators should consider. Now, perhaps I can start off with how fintech will affect asset management. So fintech's power springs from its diverse nature. I mean, the phrase fintech itself encompasses a bewildering and constantly multiplying number of companies and ventures affecting almost every aspect of the financial sector. Now, this diversity is a strength, and it explains why fintech is already benefiting investors in many ways. Yet, the best of fintech is still to come. And if we look at the long-term horizon, we can see greater progress on 4 key fronts. First, fintech can lower the cost of investing for both asset management firms and investors. Now, this matters because a lower bar for entry to invest means a higher rate of individual involvement in the financial markets. As fintech advances, it can ensure more people are investing and that they have more money to invest. Blockchain is a prime example. Now, while this technology receives a lot of attention for underpinning cryptocurrency, it has a much wider application. Most notably, blockchain enables faster data exchange, including for transactions, account changes, and investor research. And as asset managers adopt blockchain, its simplicity and speed will generate significant cost savings for individual investors. The story is similar with cloud services, where once financial companies had to build massive and costly server farms, the cloud lets them delegate these functions to a much more affordable centralized database. It also gives asset managers greater flexibility when rolling out new products and services. And it even allows for new and more efficient business models, as the pandemic proved with the rise of virtual work. Once again, the key is cost savings that can be passed on to investors. Quantum computing is even more promising. Now, it's not yet commercially viable, but that day is coming, and we can already foresee some of its applications. Quantum computing will lead to much faster data analysis and market reactions, saving countless hours that are currently spent crunching numbers. In this context, time means money, and by cutting that time down to not much longer than a blink of an eye, quantum computing will cut costs for asset managers and the investors they serve. Now, we're not there yet, but we will be soon. Second, fintech can increase access to investing. The 5G revolution is a case in point. Thanks to smart policymaking, every European country has 5G providers, giving citizens access to mobile internet speeds up to 100 times faster than 4G networks. Faster speeds allow for quicker communication between investors, asset managers, and financial companies. And as history shows, when such communication gets easier, it happens more often. Now, what's even more important is 5G networks carry far more data, which enables far more advanced investing platforms. The door is now open to smartphone apps that let consumers buy products like mutual funds, something that seemed unlikely, if not impossible, just a few years ago. In fact, we're not far from the day when consumers can purchase any investment product on their phone with nothing more than a tap of a finger. Such real-time transactions accessible to hundreds of millions of people simultaneously will be a game changer. Now, these innovations are perfectly suited for Europe. Europe's tend to be more mobile focused than here in the United States. And since 5G services can be rolled out wirelessly to rural areas that currently lack broadband internet, there's a chance to give every European citizen access to mobile investing tools. That would be a great achievement, and so would be the resulting benefits. Third, fintech can create a new area of customization. Currently, most investment products are broadly available and based on generic risk profiles. If a first-time investor wants a medium risk portfolio, they choose from a suite of medium risk options. Anything more investor specific typically takes far more time and resources and is simply not commercially available. And that's where quantum computing and artificial intelligence come in. As these technologies advance, asset managers and financial companies could affordably deliver products and portfolios tailored to individual investors. Forget generalized risk profiles. We could have personalized risk profiles. Better yet, we could have them at a snap of a finger. Consumers could lay out what they want in a text message, an email, social media post, or message through an app. Within minutes or even seconds, they could receive tailored advice and investment solutions. Individual investors have never had such choice, speed, and customization, but they will soon. The fourth and final way that fintech can better serve investors is by creating entirely new asset classes. This process is already underway. Blockchain allowed for the rise of cryptocurrencies and other crypto assets, which have become popular for many investors, including some first-time investors. And we can debate if that's a good thing or not. More recently, blockchain has led to the creation of non-fungible tokens. And these allow individuals to monetize, buy, and sell assets that were previously unavailable. Everything from art to real estate to intellectual property. Currently, ownership of these assets is defined by individual possession. But through blockchain-supported tokenization, many investors can own a piece of the asset without actually physically possessing it. This digital ownership offers the potential to democratize indivisible assets so many investors can reap the rewards instead of only a single investor receiving all the value. Forthcoming innovations will unlock even more asset classes. And as they arrive, they'll give a greater number of investors more ways to build wealth. And that's what we all want. And that's what fintech can help us deliver. Now, I think this conference has revealed that this deluge of innovation poses interesting questions for regulators. On the one hand, it's exciting. Fintech's potential is simply massive, and unleashing it will support vital economic, political, and regulatory goals. On the other hand, fintech looks complicated to regulate and poses investor protection and financial stability risks. Getting this right is no simple task. Yet there is no question in my mind that this can be achieved. I encourage policymakers to consider 3 regulatory principles as they go about this task. These principles can foster, in my opinion, smart, sensible rules that properly balance innovation and risk. First, fintech requires legal certainty. That's true for both its development and introduction into financial markets. Innovators and entrepreneurs need a stable regulatory framework within which they have the freedom to do what they do best. By contrast, a lack of certainty will inhibit the creation of untold new products and services. Risk aversion is always tempting, but it can't be allowed to rule the day. We need to be permissive enough to new fintech applications to encourage new thinking and to allow progress. And we need legislators and political leaders to support regulators in this task. The bottom line is that fintech should be given broad lanes with strong guardrails, the better to ensure it moves quickly and safely in the right direction. The second principle is an even playing field among financial services providers. More often than not, discussions about fintech devolve into a false choice. We're told we have to choose between existing players, incumbents, and innovative disruptors. But that's not accurate. Many disruptors are simply old wine in new bottles, while many old players are the most eager for new developments. It's critical that we refrain from building a regulatory framework that is biased one way or the other. The better approach enables the adoption of technology across the board. And the final principle is regulatory pragmatism, which includes a note of caution. Now, as I have noted, fintech's potential is great, and its impact will be seen in how financial firms incorporate such technology in their operations and processes. I mean, that's really where the value of fintech is going to be felt the most, in the back office spaces. Now, there's no simple or swift undertaking, so it behooves regulators and policymakers to understand the complexity involved in incorporating these new technologies. So let me give you an example of this. Currently in the United States, we are having a discussion about security settlement times. We're debating a move from our current 2-day security settlement cycle, T+2, to T+1. Now, accelerating the settlement to T+1 is good for investors and the overall well-being of the financial sector because it creates efficiencies and decreases risks. If you have a shorter settlement time, the time it takes to settle a trade, the lower the risk to the party on the other side of the trade, because shorter period of time for default or shorter period of time for the market to move against the trade, which then impacts the size of the margin requirements and liquidity pressures. So these stresses due to longer settlement times are exacerbated during high market volatility periods or market stress periods. Now, there are some who suggest that, hey, great, if we can shorten settlement to T+1, then we should go all the way and shorten settlement to T+0. And technology, fintech, appears to be the key to making this happen. Now, this sounds very appealing, but moving to T+0 would leave very little recovery time if systems interruptions took place or high market volatility occurs, raising real financial stability and investor protection concerns. Jumping to T+0 also would require a complete re-engineering of areas such as global settlements, foreign exchange, and margin requirements. The operational challenges would very likely lead to increased costs to end users. So while fintech would seem to be able to address some of these concerns, the devil is very much in the details. And thus the need for regulatory pragmatism. Yes, technology opens the door to new efficiencies. That is true. But the appropriate application of such technology must be accompanied with sufficient understanding of the operational challenges it may create. And at the end of the day, we all have a large learning curve. For policymakers, creating a regulatory landscape that promotes the best in innovation, yet maintains stability and protects investors is a steep challenge, and no one is perfect. But incorporating regulatory pragmatism into rulemaking considerations will help regulators achieve that balance and deliver the biggest benefits to all involved. Now, let me conclude by saying, despite what I just indicated, I'm actually very confident and very excited at what lies ahead. We all want a stronger economy, we all want a more secure society, and we all want a more sustainable world. And above all, we all want individual investors to reap the rewards that come from long-term investing, because that underpins all of the above. Europe is an exciting place because it has a vibrant and engaged policymaking community. This conference has shown that. Europe has a sophisticated fintech industry, and Europe has an investor community that still has yet to reap the benefits of the single market. And for this reason, I look to Europe as the place where we'll see innovative regulation that will bring to fruition the benefits of fintech to long-term individual investors. So thus, Europe can and should lead in this effort. Thank you.
Thank you very much indeed, Eric, for the speech. I don't think you had to worry about being less interesting than Robert and Jean-Paul. In fact, it shows that you spent many a day in FSB and IOSCO discussions with both of them in the same room. And I think it's interesting your premise at the beginning, because Stephen Major, who spent also time in those rooms, made the same point earlier, that he believes technology will radically transform the whole regulatory and supervisory framework over time. But you came out with a more positive message. The best of fintech is yet to come. I quite like that. We might actually use that as a theme for the 7th conference. But maybe
it's not copyrighted.
Good. I might just, I know we're running out of time, but maybe I can just ask you 2 short follow-up questions, which came out of what you discussed, which I think is very interesting. One is a bit provocative. Yes, you're very positive, but your members are effectively intermediaries, advisors, a profession that sits between the end investor and the asset class. And in a way, a lot of what you set out as the technological transformation empowers individuals to take that step themselves. Are you kind of effectively writing yourself out of history? Deliberately, provocatively.
So that is provocative. Right.
Yeah, and the other one, which is on the way more positive, because I liked your point about customization. And you know, in Europe, customization is increasingly around ESG. Environmental, social, and governance considerations in investment decisions. How do you see the interaction between technology and those type of choices?
Right. So I think the questions are actually very related. I started off with my premise that we're all working ultimately for the benefit of long-term investors. And to the extent that it is to the benefit of investors to have direct access to investment opportunities, then that's where the market is going to go. But the fact is, there's actually still a need for intermediaries in this type of investment environment. And you mentioned it in your second question. When we look at things like sustainability and ESG, we don't see the disappearance of intermediaries. If anything, we see a growing role for intermediaries because there's a lot of information that needs to be digested. There needs to be a lot of different alternative investment strategies offered to investors. In a way, investors need the assistance of the asset management industry to achieve whatever their objectives are. And if it's sustainability, I think the empirical evidence shows this need is just going to grow in terms of demand from the asset management industry. So no, I don't think we're writing ourselves out of history. If anything, I think that it shows that our role will change. Technology will make it change. Things that we formerly did, we no longer will need to do because technology will increase efficiency, will lower costs. But technology will also create new opportunities where now investors with the opportunity to do new things will look to asset management firms to help them pursue these new investment opportunities.
Thank you very much, Eric. It's been a great pleasure as always, and hopefully we'll see you again soon in Europe. Thanks for spending some time with us, which is what's still just the end of your morning. Thank you very much indeed.
No problem. Thank you.